I want to quickly talk to you about S Corporation stock basis for taxes, okay? And because if you have an S Corporation, you got to really pay attention to your stock basis, and especially for when you file your federal taxes. So let me give you the overview you need to really understand. How do you calculate S Corporation tax basis, and why does it really matter? First of all, I just want to give you some kind of general overview about everything. At its core, basis of any type represent an economic investments, right? You can measure the basis you have in assets, debts, an entity, so such as your company, and shares of stock. So this is sort of I'm just sort of giving you laying out the foundation of the conversation. So what is tax basis really? The tax basis definition we're talking about with S Corporation is the amount of economic investment a shareholder has in his or her S Corporation shares for tax purposes. And why is S Corporation tax basis important? Well, the thing is that S Corporation shareholders must know the basis they have in their stock so they can report their business activity correctly on their tax return. So when they file Form 1120S and Form 1040 Schedule C, they want to really have the right amount. So the tax consequences of certain actions will change depending on if the taxpayer has sufficient tax basis. And basis is especially important to know in the following three scenarios. So please remember this trifecta. So the S Corporation reports a loss. The shareholder sells some or all his or her shares of S Corporation stock. The S Corporation makes a non-dividend distribution to the shareholder. So in those three scenarios, tax basis is really important. So let's go with the first one. The S Corporation reports a loss. So if the shareholder is allocated a taxable loss from the business, that loss is deductible, but only up to his or her tax basis. If his or her tax basis cannot absorb the entire loss, some of the loss will not be deductible. That non-deductible loss can be carried forward, but the taxpayer can only deduct that loss when they increase their tax basis. And so if the second scenario, if the shareholder sells a sum or all of their shares of S Corporation stock, when disposing of their stock shares, the S Corporation shareholder will need to show the basis they have in their stock so they can calculate their gain or loss. And the third scenario here is that the S Corporation makes a non-dividend distribution to the shareholder. So dividend distributions do not affect shareholder basis, but non-dividend distributions will actually affect because they are considered a return of capital. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. Now let's talk about how you calculate your tax basis in an S Corporation. So if you have to file your S Corporation taxes, I already explained to you, you got to really understand tax basis. So your initial tax basis in an S Corporation is what you paid or contributed to acquire your stock shares. So let's say if you paid cash, your starting tax basis will be the cash amount you paid for those shares. And it doesn't matter whether you actually made the payment online or you made the payment in cash, like with liquid cash, if you will. It doesn't really matter. So if you contributed property in exchange for S Corporation shares, your starting tax basis will be the fair market value of that property, less any related debt the company assumed. And those fair market values are established at the date of purchase, okay? If you inherited the stock, your starting tax basis will be the value of those shares at the time of the previous owner's death. So from there, a shareholder's tax basis is adjusted up or down for taxable changes to their investment. So we're going to put this on the screen so everybody has a clear idea what I'm speaking about. So here is a simple calculation you can use to determine your tax basis. We're going to put this on the screen. So adjustments must be made in this order and in this specific order. So the starting tax basis, and then you have a plus capital contributions you made to the corporation. Those are added. If you purchase additional shares of stock, those are added. Income reported on Schedule K1, for example, ordinary income, capital gains, tax-exempt income, you add that. You also add excess depletion. And then you subtract distributions of capital, not including dividends. You have non-deductible expenses. You subtract depletion. You subtract losses reported on Schedule K1, Example, ordinary losses, short-term investment losses, capital losses, and you also have Section 179 deductions. One thing I want to say here is that when I'm talking about Schedule K1, remember, when you have an S corporation, you're filing Form 1120S every single year. Now, Form 1120S is an informational return. It's not a return on which you pay taxes as if you were filing a regular Form 1120, right? But when you file Form 1120S, you're also you're attaching Schedule K1 to all the shareholders of the S corporation. So if you have income or loss, let's say on that Schedule K1, you have to actually add it or subtract it from your tax basis. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about S corporation stock basis for taxes. Now let's talk about the ending tax basis. It's really important to understand that when we talk about tax basis, it is actually a moving target. Okay, so to understand what this basis calculation looks like in practice, let's walk you through a simple example. Let's say you purchased your S corporation shares for $20,000, and in year one, the S corporation allocated $5,000 in ordinary income and $500 in capital loss to you, right? So basically what's happening here is that you have transactions that will affect not only your Schedule K1, but also your company's financial statements. So because the entity was short on cash, you contributed $2,000 to boost cash reserves. So this was structured as a capital investment, right? As opposed to a shareholder loan, because you always have the opportunity also to have a shareholder loan. So at the end of the year, your tax basis in your S corporation shares will be $26,500. Let me break it down for you. So beginning tax basis year one, you have $20,000, right? And so when we talk about capital contributions, if you remember, the capital contributions were $2,000. You contributed $2,000 to boost cash reserves. So you add that to the tax basis at the beginning. So that's $20,000 plus $2,000. You also added the ordinary income. So basically here we have a $5,000, and so then you have to actually subtract the capital loss of $500. So we're going to put this on the screen. So when you actually take $20,000 plus $2,000 plus $5,000 minus $500, the final amount here is $26,500. So that's actually the ending tax basis at the end of year one. Okay. Now when we talk about the ordering of tax basis adjustments, ordering of tax basis adjustments is important because the tax implications will change if your tax basis is zero. So when your tax basis is zero, you may not be able to deduct a loss that's allocated to you, or you may be taxed on a distribution. So it's important to understand that, you have to really think about that. You also have to think about suspended losses. So there is a treatment to think about. So suspended losses can be carried forward to the next year. And so the character of the suspended loss will remain the same and will be added to next year's tax items. So you always want to pay attention to that sort of scenarios here. Let me give you an approach here. So when we talk about tax planning, it's important to think about tax planning. Use S corporation tax basis. So if it is the shareholder's responsibility to know his or her tax basis, because at the end of the day, you're the one who actually is going to write up those items on your tax returns, right? S corporations are not required to track or report basis for each taxpayer. They're not. It's not a mandatory thing. So because basis calculations can get complex, most shareholders enlist help from their CPAs to keep track of their tax basis. So if the S corporation tax basis is kept up to date each year, taxpayers and their accountant can use that information to make even better strategic decisions. That's important because when you actually are filing your taxes, you want to pay attention to your tax basis. So generally, what happens here is that when we talk about S corporation taxes, you need to understand that when a taxpayer becomes a shareholder in an S corporation, their focus is on the business prosperity and daily operations, right? It's not about stock basis calculation, but it's important to also understand that those shareholders must actually keep track of the value of the basis of their investment. So when a shareholder receives a K1 reflecting a loss receives a distribution or the S corporation has a change in ownership, the shareholder must know their adjusted basis amount to determine if they are entitled to claim the loss on their personal income tax return or if the distribution is a taxable event, okay? And event taxability is kind of important because it carries consequences not only when you file your tax return this year, but also in the future in case you have loss carry forwards or loss carry backs. So the burden of basis tracking falls on the shareholder, not the S corporation. Okay. So this is one thing I need to say here is that I want to show you on the screen here. We have a form 7203 rather, 7203. So basically, as of 2021, shareholders are required under certain circumstances to file form 7203. S corporation shareholder and debt basis limitations and report their stock and debt basis. So it's one of those things where you have to always keep track of certain things. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about S corporation stock basis for taxes. One thing I want to say here is that when we talk about S corporation tax basis, you need to understand that a shareholder may elect to have the S corporation's pass-through losses reduced basis before basis is actually reduced by non-deductible, non-capital expenses, right? And making this election may allow the shareholder to deduct more pass-through losses. And the election must be made with a tax return and can only be reversed by IRS approval. So again, if you remember what I said about S corporation, when we talk about S corporation taxation, you're not paying taxes at the S corporation level, right? You're just filing Form 1120S, and you're also attaching Schedule K1, and that Schedule K1, the data on that Schedule K1 will be transferred to Schedule C, Form 1040, when the shareholder files his or her tax return. So it's important to really pay attention to the fact that there is no such thing as negative basis. So when decreases actually exceed the adjusted basis amount, the basis can never go negative. Instead, the excess loss is suspended, right? Suspended losses and carried over to the succeeding taxable year. And so the suspended prior year losses and deductions are treated as incurred in the current year and added to their shareholders' current year loss and deduction items. So this is one of those things where you have to always pay attention. Now, one thing I want to say that in some cases, when you have an S corporation and you have distributions, the distributions can actually carry a certain, a certain element, a certain flair of legality or non-legality. So let me explain. A non-dividend distribution from an S corporation is a payment made to a shareholder that is not classified as a dividend. So non-dividend distributions to the shareholder are generally a tax-free event as long as the distribution is not over the stock basis of the shareholder. And if the distribution exceeds the amount of stock basis, the excess distribution will be taxed as a capital gain. Now, capital gain taxes, the tax rates are 15%, 10%, 15%, 0, 5, 10, or 15%. It's not the regular ordinary tax rate, okay? If the stock was held for more than a year, the capital gain is a long-term gain. Otherwise, it will be taxed as a short-term capital gain. So short-term capital gain, the tax rates are a little So when we talk about stock basis for taxes, we also have to think about an ancillary concept, and that ancillary concept is debt basis. So what happens here is that there is a strong correlation between your stock basis and your debt basis as you're trying to really as you're trying to write off certain losses on your tax return. If you're an S corporation shareholder, you got to pay attention to debt basis. So when a shareholder makes a direct loan to the S corporation, the shareholder will have debt basis. And it is important to know that only when the S corporation owes the shareholder directly, it creates debt basis. If the shareholder personally guarantees an S corporation's loan to third parties, this does not constitute debt basis. And once the stock basis of the shareholder has been reduced to zero, pass-through losses and deductions can still be deducted to the extent the shareholder has debt basis. So you got to have, if you're an S corporation shareholder, you got to have a debt basis if you really want to make effect of certain deductions. And one thing I wanted to say here is that you got to pay attention to the fact that when we talk about the Form 7203 that I showed you earlier, that form, the IRS is really paying attention like crazy. Like lately, they're paying attention like crazy to that form. So it's one of those things where it's all about it's all about more scrutiny from the IRS, right? The agency wants to make sure that they're tracking those bases really, really regularly now. So Form 7203 that I showed you earlier is required to be filed if the shareholder is claiming a deduction for their share of a loss from the S corporation, if the shareholder received a non-dividend distribution from an S corporation, or disposed of stock in an S corporation, or received a loan repayment from an S corporation. And the thing is that even if the shareholder does not meet these requirements to file Form 7203, it is really advisable to complete Form 7203 in order to properly maintain basis year after year. And that's what you want to do, Now, one thing I also need to talk about is reconstructing basis. So if the shareholder's basis has not been tracked in years, it is imperative to collect prior year K1s and capital contribution records from the day the investment in the S corporation began. Once all prior year records are available, start with year one and prepare basis schedules for each year until present day. And you got to have that. So record keeping and supporting documentations are a must to support the adjusted basis amount today. And if a shareholder has not kept track of their stock and debt basis, it's important to start today. Even if the S corporation has shown profits year after year and no distributions have been made to the shareholder, you got to verify that the basis has been kept up to date and properly accounted for. Okay, and this could save everyone time and proper tax treatment in the future. Let me give you a few pro tips. So when we talk about S corporation stock, you need to understand that this could be a very simple concept as long as you have the ability to actually track things properly. One thing I want to say here is that when we talk about stock basis, you also have the ability to track stock basis using Schedule K1, Form 1120 or Form 1120, depending upon what kind of situation you have. Okay, and on Schedule K1. You want to start with your initial capital contribution or cost of the purchased stock. You want to add your ordinary income. You want to add taxable income. You want to add also a tax exempt income. You also want to have you also want to add in certain cases excess depletion, as I showed you earlier. It's one of those things where on Schedule K1, excess depletion is box 15C. Now, one thing I want to say here is that this will be too long to explain here, but what I want to say is that when we talk about excess depletion, this box is primarily used by companies in the oil and gas industry. They use natural resources. So if you are in that niche, you'll be thinking about having that. One thing I need to say also is that when we talk about tax exempt income, basically we're speaking about the distributions from Roth IRAs and Roth 401ks, municipal bonds, and most benefits from companies' health insurance plans. So it's one of those things where you have to really think about what really works for your particular S corporation. One thing I need to say also is that when we talk about S corporation stock basis, we are also important to understand that you can apply the same similar concept to a C corporation. So the same way you track S corporation stock basis for taxes, you also, if you are a C corporation, you also need to track C corporation stock basis for taxes, especially if you are going to convert. If you're going to go if you are a C corporation but you want to file taxes as an S corporation, then there are certain elements to really keep track of over time. Thank you so much for your attention. I really appreciate it. In today's conversation, I spoke to you about S corporation stock basis for taxes. So let me do a quick recap here. So I give you the overview, the approach, and now the pro tips. Thank you so much. God bless you. I'll see you next time. Until then, remember, stay marvelous.